And we're back live here from the Mo Summit, brought to you by Big Path Capital. We're live with Jack Robinson, the Vice Chair and Portfolio Manager of Trillium Asset Management. That was a tongue twister for me. I don't know why I started over my words there, Jack, but nonetheless, what brings you to the Mo Summit?
Well, Trillium, just a note on Trillium, has been around since 1982. And we have been involved investing in what is now called ESG, but in those days there were different names for it. We know a lot of the companies that are here today, and we've helped a number of them. We've been investors in some of them. So we invest in what we consider to be sustainability companies, and are particularly interested in companies that integrate ESG into their overall strategy and culture and have success doing it. So we are here to see them, to support the organization. I think it's a very good thing that this summit is being held, because this group really hasn't had, in my opinion, a rallying point, and nor have this group been properly recognized for the work they do. So this is a step in that direction, because innovation is part of the solution, absolutely critical part of the solution. So the more that we can reward and recognize innovative startup companies, the better. So we're all for it, and as they say, we're actively involved and invested in some of them ourselves, although we're primarily in the public markets.
And Jack, we were speaking at breakfast this morning.
We were.
And you were telling me about your career and how you kind of got into this space. And you were a pioneer in this space. Could you tell our audience about your career path?
Well, yeah, it's sort of interesting. I was in the what I would call traditional investment business in Boston, and was fortunate. I grew up on a homestead in Connecticut that was based on a book my parents wrote during the Second World War called the Havmore Plan. So I grew up with small-scale livestock and bees and firewood and passive solar. And that book, the Havmore Plan, became a company called Garden Way. And Garden Way was a company that sold tillers and carts and everything you needed to be sustainable, self-sustainable. Now remember, that was during the Second World War, and during the Second World War there were shortages of absolutely everything in this country. There were shortages of food, there were shortages of fuel. So it was a time when 75% of the household had gardens and needed to know more about it, and wanted to know about it, because how in the world are they going to get by for their families? So that book, as I was saying, became the background, the baseline, the foundation of this company called Garden Way. Fast forward, when I was in the investment business in Boston, the CEO of the company came to see me in Boston and said he needed a new CFO, and would I be his CFO, and move to Vermont. And I said, sure. I knew the man quite well. He happened to be my godfather. And moved to Vermont and became the chief financial officer of Garden Way, which was a $125 million primarily gardening and self-sufficiency company. And we called it not-for-profit only. But I also was the CEO of a foundation that we supported called the National Gardening Association. So I learned in that program, in that process, that you could be socially and environmentally responsible and not have it adversely impact the bottom line. In fact, just the reverse. As the CFO, I could see that our most profitable product was taking old tillers and exchanging for new tillers and rebuilding them and reselling them, just like a truck, pickup truck. And that was our most profitable product, and other things we did. We had passive solar. We sold solar greenhouses. We sold wood stoves, which we would probably frown upon today simply because of the pollution. But again, books and everything you needed. So I did that in Vermont for several years, but learned firsthand two critical things. One is that you can be socially and environmentally responsible and not have it adversely impact the bottom line. In fact, just the contrary, just the opposite. And that the other thing I learned is that I didn't really like being responsible for 1,400 people. That's the CFO in those days, and unfortunately these days, the HR person reported to the CFO, which in that case was me, which is still the case in this country. And that the idea occurred to me, well, let me go back into the investment business and integrate green thinking into the investment process. Now, this is now 1982. And having seen firsthand how it can augment profitability and enhance the positive impact on all stakeholders, which is a term we were using in those days. I said, why don't I do a startup and start a money management firm and integrate green thinking into the investment process. I've seen it at work. So I didn't go out and do any testing at the time of what back testing it would have been, nor did I fully appreciate there weren't really any green companies to invest in. So when I started Winslow in 1983, it was based on negative screening. So we'd screen out what I called the dirties, and we'd screen in the cleans and the greens, but keep in mind there were no greens at that time. So it was all based on screening out about 35% of the overall market, and that would be oil and gas companies, tobacco companies, nuclear companies, munitions companies, what you might think of as bad companies, so we call them dirty. So we built the business on that, and fortunately I had a couple of clients who said, well, what does this mean, Jack? How much am I going to have to sacrifice in terms of performance? And I said to them, I honestly don't know. And I didn't. I said, but if you try it out, I don't think we'll go too far off the track, and we'll stay in touch. And so we did that, and it worked actually quite well. So that is when I focused, when Whole Foods went public in '91, and there was a bona fide public company that could pass most of the green screens that anyone would run, even then or today. That was the beginning of being able to invest in companies that were having a positive impact, such as the 100 companies that are being recognized at this conference.
Interesting. That's a lot. So when you're investing in these green companies, what's the most important thing that you look for, either in the leadership or in the business model?
Well, it's all important. I mean, just because you're green doesn't mean you're a good investment.
Exactly.
I've certainly learned that. So there has to be transparency and a consistency of whatever aspect of sustainability that's important to you that you're looking for. So the key comes down to, really, it's the people, and is it the corner office, the board of directors, the CEO, CFO? Those are the three key areas. And if that group or people within those groups aren't committed to making a difference as well as making a profit, then it's not going to happen. So you have to determine and figure out whether or not they're true to their word. There are many, many people in this area of investment today who are simply here because it represents an opportunity. They're being opportunistic. And if you don't genuinely embrace the whole concept of sustainability, then ultimately you'll fail, in my opinion.
We were speaking a little bit earlier about mergers. Your company had been acquired, Winston, and then you stuck with the company.
Winslow.
Sorry,
Right.
excuse me. And you stuck with Winslow to make sure things went well. How important are post-acquisition mergers to make sure that these companies, say like a green company gets bought out by a larger company, like Dollar Shave Club gets bought out by Unilever. How important is it to make sure that that company maintains its core values and principles?
Yeah. Well, for most entrepreneurs, it's really important because one of the reasons for starting a company that's making a positive impact is that you want the impact to go on. In other words, this is your legacy, or one of your legacies, if you have a whole series of these. So, in order for it to be properly integrated and with the larger company, it's important that the founder or the management team or members of the management team work with the client to help integrate it into the overall. So we heard earlier from we talked earlier about Unilever and what they're going through, having acquired a number of fast-growing impact companies such as Seventh Generation and Ben & Jerry's. And the fact that in the recent acquisition of Seventh Generation, the CEO is staying involved, and as well as the founder of the company, with the new owner and on an advisory basis, and that they're being listened to, is having a wonderful influence on the overall company, and will, in my opinion, continue to augment their growth in a positive way. So, to answer to your question, some acquisitions are made simply because the larger company sees it as an opportunity, a financial opportunity. Those acquisitions tend not to do well because the culture does not live on, or it's not integrated. But some do exceedingly well, and we just talked about Unilever, and that hopefully will do really well. But in my case for Winslow, the acquiring company has people involved at senior levels who are very green environmentalists, and they have a number of environmentalists on their board of directors, and it's something they wanted to do. It was a vehicle they didn't have, an expertise they didn't have, and some of the people that we hired at Winslow are still with this company, Brown Advisory, and the public fund they manage is the top public fund based on performance in the space. So they're doing very well.
So when you were starting out,
yeah,
and your partner asked you, "Jack, is this going to make me money?" You answered, "I don't know." How would you answer that differently today?
Well, today, that's a good question, Kevin. Today, there are, if you're talking about an investment company and investing in the space, today there are many companies that are in the space or coming into the space and startups. So there's no lack today of positive impact companies to invest in, certainly on a private basis, but increasingly on the public side. So the universe to select from has gone from zero, basically, up to almost unlimited number of companies that one could invest in, thinking globally. And the other part of it, of course, you need to have clients, investors who want to be in the space. And the fact that there are more investors today that want to be investing in this space, however you want to define it, is good. So you've got the supply of companies on one side, you've got the supply of investors on the other side, and it's a matter of putting the two together and making reasonable returns, however you define that. In other words, you can define it based on just financial, or just impact, or some combination of both. And I've always believed and believe today that you can do both, and actually make more money if that's your focus, by integrating sustainability into your company plans and culture. And on the other side of it, you can do exceedingly well with impact as well. So they can be together. They don't have to be one or the other. And one of the exciting things going on today is that some nonprofits or NGOs are looking more like for-profits, and some for-profits are looking more like nonprofits. So whether we've got this B Corp whole thing going, which is very exciting. We still don't have a public company, a bona fide public company that itself is a B Corp. We have Unilever and others that own companies that are B Corps, but that's going to get integrated in, and B Corp, it's another discussion, but that's an important part of the program moving it forward.
Yeah, it was interesting. I was just in that session when you walked in, and this woman I was sitting next to, Anne was her name, she's saying, yeah, I work for a nonprofit, and I came to this meeting to find out how to become a B Corp, how to become a for-profit. Because she's like, because I know in the long run, we won't have the revenue stream to sustain this company. So taking a look at that and switching and converting over is something that we are interested in. So it's definitely interesting times. How do you think people's perceptions of green businesses have changed from 1980 to 2019?
Wow. Well, they've not a full 180 degrees, but because we in the green business, and when I say green, I mean sustainability, I mean ESG, impact, the broad range. There are an increasing number of successes that we can point to. And as opposed to just talking about it and saying, we think this is going to work, we can say, here's an example of something that's actually working. And so it's not just the talk, it's the walk, and it's there. And there are many examples of private and now increasing numbers of public companies that are doing exceedingly good things.
What's the biggest misconception about, you mentioned, am I going to have to take a cut?
Yeah.
Is there more risk?
Yeah.
A lot of my friends, parents, I'm not going to invest in that because it's not going to affect me in my lifetime. We were having this conversation, how do you get someone out of your niche to at least think differently?
Yeah.
How do you approach an investor like that? How do you approach a friend like that who might not have the same way of thinking as you do?
Well, my wife and I recently had dinner with the retired chairman of a major bank in the U.S., and we were talking about what she's doing and what I'm doing in there. And his response, he would answer that and say, don't even talk to anybody over 65. He said, you're wasting your breath. They're not going to change at all. So there's a little bit of that in my answer to you. I'd much rather talk to millennials about what's going on, or there are others in different age groups that get it or want to get it. It seems rare for the older generations to really be open to change and new ideas, which is very unfortunate, but that is the fact of life. Now, the other side of this is we're getting more and more better understanding of the financial impact of not behaving in a responsible manner, and more companies are showing up and with major losses. I mean, for example, I was talking with a CEO of a major investment firm in Boston, a traditional investment firm, $500 billion under management, international. And we were having lunch and talking about ESG investing, because they had never done it. 5 years we would have never had that discussion. And we had this discussion, and one of my questions to him was, well, Ted is his name. I said, how are you going to change your corporate culture? You've got most of your investment people don't believe in screening or positive screening or ESG or sustainable investing. Well, how are you going to do that? And he said, well, I have let the investment people do their own thing for a number of years, but I'm going to take this on myself, and I've just started. He said, my goal before I retire is for all 500, every dollar we manage to have ESG integrated into the investment process. I said, well, how are you going to do that? Well, it's by example. I had a meeting, my first meeting with our investment teams international the other day, and I said, they started to question me about this and asking me, well, why are we doing this? And he said, would you buy Wells Fargo in any of our clients' accounts today? Of course, the answer is no, because Wells Fargo and the governance there is outrageous. It's so bad. And so governance is just one of the three categories that are truly important, and that's a good example.
And that's the next question I was going to ask you, is how important is sustainable leadership in today's corporations?
It is becoming more important. Some corporations have their own sustainable committees at the board level. Now, every board generally has an audit committee and a governance committee and a compensation committee. Those are the three basics. But more companies are beginning to integrate sustainability as its own committee, or they are integrating it into the audit committee as an example. For example, and let's just talk about that. Today, with climate change being the big hot button, I mean, it is a challenge bigger than anything else I think we're ever going to face as humanity. And we need to get it right, and we need to get it right soon. And I am beginning to see sustainability integrated into the audit committee. So if you can look at ESG just from the risk side, which is a risk, but then you need to be thinking about solutions as well. And that audit committee isn't always the best point of reference for solutions, but it gets the ball rolling. So we're going to see it at the board level, because boards are asking questions. The SEC is requiring increasing disclosure about climate. So climate is a question that we would ask any company, any ESG investor would be talking about climate with their portfolio companies prospectively, or they already own. And so it's working its way into the whole investment process.
Jack, you've been in this game for a long time.
I'm old.
What keeps you going?
Well, I think we have a big challenge here, and it's never been bigger than it is today. And to any way that I can be helpful and move the ball and help others move the ball, more importantly, on helping solve these big environmental problems and ESG issues as well. But to me, my primary interest is climate, because I think it's such a huge challenge for all of us.
Well, Jack, we appreciate your time here on Real Leaders Live. Thanks for coming on and sharing your knowledge with me, especially. I wish I had your long-term vision, thinking, and everything like that. And your knowledge is great for not only myself, but our viewers. So I hope they enjoyed it as much as I did today. For everyone back at home, Kevin Edwards telling you all to go out there, think long-term, make good decisions, take Jack's advice, and always, folks, keep it real. Thanks for coming on the show, Jack.
My pleasure. Good to see you guys. And keep going. You're part of the solution too.
We're trying. Jack Robinson, everybody. Trillium Management. Trillium.